Hi, everyone. Thank you so much for joining the GIS podcast. Today, we have an amazing guest in Mr. Anson Frericks. We'll briefly introduce ourselves and then get to our guest. I'm Aditya. I'm a junior here at USC Marshall studying business, and I'm head of events here at GIS, and I'll pass it over to Cindy.
Hi, I'm Cindy. I'm a senior and the president of GIS.
Yeah. And for today's podcast, we have an amazing guest in Mr. Anson Frericks. He was at Harvard Business School before working at Anheuser-Busch and then eventually co-founding Strive Asset Management, which now manages over $1 billion. So without further ado, Mr. Frericks, could you share with our listeners your background, and then we can go from there.
Yeah, definitely. So first off, thanks for having me here. I really appreciate it. I was in your guys' shoes at one point. I actually went to undergrad at Yale University. I did a couple internships on Wall Street, and after undergrad, ended up at a private equity firm out of Boston called Summit Partners. So I spent my first couple of years out of school at a private equity firm. Went back to business school, as you mentioned, at Harvard, and then coming out of business school, I was actually recruited by the guys at 3G Capital, who had bought Anheuser-Busch in the United States. And they convinced me to come work for what they said was the world's largest private equity firm that happened to sell beer. So that was a pretty good sales pitch. I helped buy Grupo Modelo. I helped roll a bunch of craft beer companies in the U.S. and it was president of Anheuser-Busch. And then a couple of years ago, went back to kind of my roots in finance and co-founded a company called Strive Asset Management with a buddy of mine from high school, a guy named Vivek Ramaswamy, who when we originally started Strive, he wasn't supposed to be running for president, but like any great startups that I'm sure all of you will be part of in your careers, you'll notice that there are ups and downs along the way. So anyway, we co-founded Strive together. Strive now manages over $2 billion worth of capital in both public equity, exchange traded funds, and then we also have a couple actively managed fixed income funds as well. So looking forward to chatting with you all today.
100%. Thank you so much for the background. That was super helpful. Yeah, first question I had was you mentioned you left Anheuser-Busch to co-found Strive. First, I'd love to know kind of what prompted that shift and why you decided to co-found Strive.
Yeah, I mean, funny enough, I just released a book on this
Yeah.
last month. I mean, the book's called Last Call for Bud Light, and but really talks about this broader sort of problem that was going on in corporate America over the last 4 or 5 years. And fundamentally, there was this big discussion about really what is the purpose of a corporation. And this purpose of a corporation is what was driving, I think, a lot of the discussion that you're seeing more broadly in corporate America around narratives like ESG, environmental social governance investing, diversity, equity, inclusion. And one of the reasons that this has become such a sort of political hot button is historically in the United States, if you go back to the 1970s, the purpose of a corporation, as Milton Friedman defined it, famous economist, New York Times, 1970s, says the purpose of a corporation is to focus on its shareholders. How do you focus on your shareholders? You focus on your customers, and you give them great products, services that allows the business to grow. Around the same time, there was this other idea that was more of a European concept called stakeholder capitalism. And stakeholder capitalism kind of purported to do the same thing as shareholder capitalism, said it was going to make good returns, says it was going to do well by society. But they said the purpose of a corporation is to serve all stakeholders equally. And think about it as a stakeholder can be, I mean, anything. It can be a supplier, it can be a government organization, it can be activist, it can be, budget. Basically, anybody can be a stakeholder. And think of it as almost businesses were supposed to be more of sort of working in hand with government to try and kind of drive societal change. And this really came to a head over the last 4 or 5 years when in the United States, a group called the Business Roundtable, and kind of being led on by a group of very large asset managers in the United States, BlackRock, State Street, Vanguard, sort of evolved the purpose of a corporation in the 2018, 2019 timeframe away from this Milton Friedman shareholder focus toward this stakeholder focus. Subsequently, you had COVID happen, you had issues like George Floyd happened, and then businesses all of a sudden decided to get involved in much more sort of social justice and issues that used to be unrelated to their mission. At the time, you might remember, I was actually living in Atlanta when Coca-Cola made a big statement when Georgia implemented a law that said you need an ID to vote. I think 30 states have that law, but Coca-Cola decided they're no longer in the business of soda and pop. Now all of a sudden they're in the business of telling Coca-Cola or telling the state of Georgia that they were wrong to implement this law. You saw other businesses. Disney obviously got involved in a parental rights issue down in Florida. Should you teach sex education to students in K through third grade? A lot of people sort of raised their hands and said, why is Disney getting involved in this? Isn't their mission to entertain the world? So these were examples of a lot of businesses were getting involved in more social political issues unrelated to their mission. I saw this when I was working firsthand at Anheuser-Busch with other companies getting involved internally at Anheuser-Busch. I saw their even culture change. I tried to do a distribution deal with a coffee company called Black Rifle Coffee Company, whose mission is to serve coffee and culture to firefighters, police officers, law enforcement, military, and people who love America. But 2-3 years ago, that was deemed not appropriate at the time. In the light of the broader DEI, diversity, equity, inclusion movement, that at the time was trying to defund police and get involved in a lot of other military issues. All of a sudden we said we couldn't do that. That was kind of eye-opening to me. Didn't make a lot of sense. The company Anheuser-Busch did away with merit in terms of hiring, introduced more diversity dashboards, which were becoming very controversial, and quota systems were becoming controversial at companies. And so I was having a conversation about all these issues with my high school buddy, Vivek Ramaswamy. And instead of complaining about this, we decided, well, there's really a big fiduciary breach which is going on, which is the largest so-called owners of these corporations across America, BlackRock, State Street, Vanguard. They were the ones that were all pushing companies to get involved in more of these social political issues under this broader banner of ESG and DEI. And we said that's a fiduciary breach. There might be some organizations and some people that want companies to get more involved in politics, but then there's a lot of people that just believe more in this Milton Friedman view, that businesses should stick to business. That's the best social good they can do. That's the most sustainable thing a business can do. Focus on your customers. And so we decided to create a alternative asset management company to BlackRock, State Street, and Vanguard that were managing 401ks and pension funds and others. And we said, well, all of them, we're going to have companies get more involved in a lot of these kind of political social issues. We just said at Strive, we're not. We're going to be focused on sort of American free market shareholder capitalism principles, as Milton Friedman sort of subscribed. We thought we'd be a better fiduciary to the vast majority of Americans that we thought believed in us. And I think 3 years ago, this was a very contrarian position, but we think it was the right position. And that's allowed us to now manage a firm with billions of dollars of assets. And it's been funny to see a lot of other people that were very much fighting us 3 years ago have now come around and now follow a lot of the same principles that we do.
100%. Thank you for that answer. That was super interesting. And I had a couple of follow-ups to that. But first off, I'd like to give you the chance to speak more about your book. I saw it released on Feb 4th, The Last Call for Bud Light. And I saw you did a few podcasts about it as well. Super interesting. So I'd love to give you the chance to tell our viewers a little bit more about the book first off.
Yeah, I mean, there's a bunch of other podcasts folks can listen on. I know we're talking more about Strive here, but the broader narrative, what was really interesting is that, I was president of Anheuser-Busch. I left a year before their partnership with Dylan Mulvaney. And I think Dylan Mulvaney and that whole entire incident with Bud Light, I think that became almost the poster child of what went wrong with the broader ESG, DEI, and stakeholder capitalism movement, where they tried to put sort of a uniform policy on almost every single company across America, instead of allowing each company to focus on its individual customers and brands. And what was really interesting about the whole Bud Light case was this was the first time that you saw a company, really definitively lose millions of customers, billions of dollars of shareholder value. You saw thousands of employees get fired across the Anheuser-Busch system. You had suppliers that went out of business because a company got involved in sort of a political controversy that was unrelated to its mission. And specifically that mission of Bud Light as a brand was the biggest beer brand in the United States. It became the biggest beer brand in the United States because it was actually remarkably apolitical. It was enjoyed by Democrats and Republicans alike. When you looked at surveys of the brand, it did that because it usually just used humor, it used sports, it used music festivals, backyard barbecuing, things that bring people together. It never really touched political issues. And all of a sudden, when it did a partnership with Dylan Mulvaney and sent Dylan Mulvaney a can with Dylan's face on it to celebrate Dylan's 365 days of transitioning from a biological male to a female. And this was just a very hot political topic over the last couple of years, especially because Dylan was kind of at the forefront of advocating for gender affirmation care, allowing for biological men to compete against women in sports. Dylan was at the White House with Joe Biden talking about a lot of these policies. In the exact same way that probably Bud Light shouldn't put Donald Trump's face on a can, because that would also be alienating to a lot of its customer base that never got involved in politics. Dylan was just sort of the wrong person to put on the can. But the book talks a lot about all the reasons why Anheuser-Busch had adopted a lot of ESG policies, DEI policies that were foisted on it by a lot of large asset managers like BlackRock, State Street, Vanguard, why a lot of stakeholders like the Human Rights Campaign, which essentially tells companies that they have to get involved in more of the divisive LGBTQ issues that Dylan Mulvaney was advocating for, to receive a perfect score that they can put on their website, that gets them included in certain indices that BlackRock and State Street and Vanguard put companies into, that brings more investors to them. Why all of this went wrong and why it was actually bad for the company to adopt this policy. So it uses sort of the whole Bud Light story to tell sort of the broader story of other businesses as well, that I think made the fallacy of getting off track from their mission, trying to get involved in every single social and political issue that you've seen over the last couple of years. It's been, again, defund the police, Roe v. Wade, the Supreme Court's decision to overturn affirmative action in Harvard versus, or Students for Fair Admission versus Harvard. A lot of companies took positions on these issues. At the end of the day, it kind of fragmented their customer base. It led to declining revenues, and then it didn't necessarily solve a lot of these better societal issues as well. So the book talks about that broader issue, but mostly through the whole Bud Light story, which again became sort of the company that was holding the pin when the ESG bubble popped.
Got it. No, thank you so much for that overview. Seems like a really interesting book as well. And I had another follow-up to what you mentioned initially. You mentioned the concept of fiduciary duty. I'd love to know kind of how you think it's evolved over the past few decades, and why you think it's been neglected recently, and kind of how Strive is tried to address that issue.
Yeah, definitely. So fiduciary duty, it's a real legal concept. And really what it means that if you're managing somebody else's money, you have to act in the best interest of that person. You almost have to take on their identity and what they would do if they were just investing on their own. And so that's not only in terms of how do people want their dollars invested to maximize returns, but then especially over the last 5 or 10 years, it's become really important about how you actually vote proxy statements at companies and how you do engagement at companies. So what do I mean by that? So if you own a share of a stock, that gives you the ability every single year to vote in what is known as shareholder proxy contest. And if you have a certain number of shares of stock, you can put up proxy statements. This allows you to vote for the board of directors of companies. This allows you to, you can put up something that asks a company to take a look at its environmental policies, its social policies. You can really ask companies to almost do anything if you own a certain number of shares. And you get typically the amount of shares you own of a company gives you the proportional right to vote. And think just like an election, if you get more than 51% of a board member votes passing, that board member gets appointed. If you have certain proxy statements that are asking companies to, over the last couple of years, when people put up things to defund the police, PETA, People for the Ethical Treatment of Animals, puts up, proposes Starbucks, we don't want you to use any milk. But if you start voting for these, I mean, if 51% of it passes, then companies are going to have to abide by them. And so this has become a real big fiduciary issue over the last, call it 5 to 10 years, when you had firms like BlackRock and State Street and Vanguard that became very pro-stakeholder capitalism, pro-ESG, pro-DEI, who, when they're managing the $20 trillion of capital they manage, it's not their money. It's mostly money that's being managed on behalf of everyday people, everyday citizens, via their 401ks, via their pension funds. And all of these firms really adopted sort of the same pro-ESG, pro-DEI policies. And the issue with that is that there ended up being a big fiduciary breach, because certain people said, hey, I just want you, BlackRock, State Street, Vanguard, to manage my money, invest it to make a great return, period, that's it. There became other individuals, like the state of California, their pension fund, for example, or like Harvard University's endowment, European sovereign wealth funds, that said, if you're going to be managing my money, we actually want you to try and do more social engineering. We want you to be actually telling oil and gas companies, for example, to drill less oil and gas, even if it hurts the bottom line of those businesses. We want you to be voting shareholder proxies at companies. I'll give you a good example. Apple. Apple's located in California. 2 years ago, there was an organization called Color of Change. And Color of Change is a nonprofit activist group that says we want to stamp out systemic racism in society. So, okay, fine, good enough, idea. You're a nonprofit, you can do that. But they went to Apple and they put up a shareholder proposal, because they own $25,000 with Apple, that says, we want you, Apple, to figure out how you have contributed to systemic racism historically in the United States and what you're going to do to solve it moving forward. And even Tim Cook, who's the CEO of Apple and Tim Cook's board of directors, said, guys, I understand what you guys are trying to do, but like we at Apple, our mission is to make, magical devices at unbelievable prices. Like, this is important stuff, but like, we just don't do that. So we're going to recommend against this policy because we don't think it's in the best interest of shareholders. A lot of our competitors that are in China or overseas, like they're not spending tens of millions of dollars a year to try and right historical wrongs. So we would recommend against this. But BlackRock was actually the deciding vote. They owned 6% of Apple. They voted affirmatively for this racial equity audit. It passed by 52 to 48. So now Apple is now conducting a whole racial equity audit about how they contribute to systemic racism historically and what they're going to do moving forward, even though the board said this had nothing to do with shareholder value. It was a political statement. So a lot of these things were going on over the last couple of years. Just the numerical numbers. Before 2020, you had less than 5% of these so-called ESG or DEI proposals, like the one I just mentioned, that would pass at corporations. And then in the 2021 timeframe, BlackRock voted for over 40% of them. So you saw this massive increase, asking oil and gas companies to decrease their production of oil and gas, asking for companies to do racial equity audits, asking companies to either do defund the police initiatives or move away from military contracts, things that even though it would hurt the bottom line of companies. So it wasn't really about necessarily the bottom line and companies making dollars. It was more about these political statements. That's where the fiduciary breach came in, because you now have to have two separate customers. You have to have ones for the state of California's pension fund, New York's pension fund that is advocating for these things, but then other states like Texas or Florida or just other people in the country that said, no, I just want you to manage my money. You can't be doing both with the same people's capital. You have to make a split. And that's where we sort of came up with Strive and said, hey, if BlackRock, State Street, Vanguard, and almost every other asset manager, they zigged towards this stakeholder sort of capitalism structure and they wanted to serve those customers, but everybody else was brought along with them. We at Strive said, we're going to do something different and contrarian. We're going to zag back, and we actually want to manage money on behalf of people that just want business focused on their mission, making dollars for shareholders. We think that's the best way to actually solve societal issues. Most social justice issues are just a business problem hiding in disguise. Let oil companies be oil companies, let Apple be Apple, let Starbucks be Starbucks. Let's let them run their businesses. Don't necessarily have them be kind of companies of social change. So that's how we created Strive, to be a better fiduciary to those customers.
Yep, thank you so
Got
much.
it. I mean, you mentioned about fiduciary duty, and I think you hinted about shareholder activism and corporate accountability. So against this backdrop, how does Strive engage with companies it invests in to ensure they're focused on maximizing the shareholders' value?
Yeah, so there's really two key ways that we do it. And one, we believe investing in businesses is the best way to drive change. We don't believe in excluding companies from index or from our funds. So what we do is we launch really just passively managed exchange traded funds. So we have large cap value funds, large cap growth funds, energy funds, semiconductor funds, and we invest into businesses. And that gives us the ability to vote in those shareholder proxy contests, as we mentioned, where we vote through the sole lens of maximizing shareholder returns. We're not necessarily voting for politicized proxy statements. And then secondarily, we actually do a lot of writing to CEOs. In the same way that Larry Fink, who's the CEO of BlackRock, was writing annual letters to CEOs, telling them how companies need to earn their social license, telling him about his policies on ESG and DEI that he expected all companies to abide by. We said we were a different shareholder in the companies. And on behalf of our constituents, we believe that you have a fiduciary duty to your shareholders, of which we now represent, and that duty is to maximize returns for them. And so we did a lot of campaign writing. One of the first CEOs that actually engaged with us in a meaningful way was Darren Woods. He's the CEO of Exxon. And this was in 2022 when we first launched our business. And the year before, Exxon was involved in a large proxy fight where BlackRock, State Street, Vanguard, and others voted for climate activists to be put on the board of Exxon, which asked Exxon to decrease their oil and gas production to meet Paris Climate Accord agreements and other agreements that the U.S. had never signed up for. It would essentially hurt the shareholders of Exxon. We said to Darren, we said, hey, we're new shareholders. We think that you should be very proud to be an oil and gas company in the United States. We think you should drill for oil and gas. The world needs more oil and gas at this point, not less. And if we don't get it here in the U.S., we're going to have to get it overseas from China or Iran or Venezuela, somewhere else. And so Darren engaged with us, and then we had a dinner with Darren. We actually asked him to add 2 more board members to actually kind of more balance out the board, which he did. We also wrote letters to multiple different companies, to Disney, after their CEO at the time, Bob Chapek, had really hurt Disney's net promoter score, had really hurt its image by getting involved in the Parental Rights Act in Florida. They lost millions of subscribers. Their stock cratered at the time. And Bob Chapek was eventually fired by the Disney board. So we've written a bunch of letters to companies as well to make sure that the business are focused on their mission, driving shareholder value, not necessarily getting involved in a lot of political activism.
Well, you've been very outspoken about shareholder privacy. So, shifting gears, we're curious to hear what kind of advice or thoughts would you give to individual investors who are concerned about how their investments are being used in order to influence corporate politics or things that doesn't directly contribute to companies' growth?
Yeah, this might be a little bit self-serving, but I'd say 3 years ago, people didn't really have a lot of choices. Almost every single asset management company was promoting an ESG, a DEI, and the stakeholder capitalism view of the world. And it was very contrarian when I think Vivek and I launched this at the time. A lot of people called us anti-DEI or anti-ESG or anti-woke company. And for us, that was never what it was about. For us, we were a pro free market shareholder capitalism, kind of American free market capitalism company. And so what I would tell individual investors is if you're concerned about a lot of these issues, if you didn't necessarily like when Anheuser-Busch and Bud Light partnered with Dylan Mulvaney, that drove the millions of customers away, it drove $40 billion of loss. Well, now there's a firm called Strive that's advocating for companies not to get involved. And I even think if you take a look at the longer term perspective, take a look back. I think that what Strive and the Strive message is what we're bringing. I think it's going to be really good for two reasons. I think one, it will lead to better long-term returns in the market, and then two, I think it'll be better for our greater prosperity as well. Why do I believe that? Well, if you take a look at sort of the Milton Friedman model in the U.S. versus the more European stakeholder model, which was also started in the 70s by Klaus Schwab, kind of the World Economic Forum group, both purported to do the same thing, which was to do a better job driving shareholder returns and do a better job of providing better societal outcomes. And if you take a look, if you had $100,000, for example, and you could invest in the broad-based stock market indices in the 1970s in the U.S. versus Europe, that $100,000 in the U.S., like S&P 500, would be worth $4.5 million today. In Europe, it would be worth $1.5 million due to the compounding interest of money, where the U.S. markets have returned about 10% on average over that time. Europe has only returned 7%. So the U.S. has beat Europe in terms of an economic system. And then Europe might say, okay, well, did Europe have better societal outcomes? I would just say no. If you look at almost every single broad-based prosperity metric, from GDP growth to per capita income to unemployment rates to interest rates, the U.S. has beaten Europe on all of those as well over the last 40 years. So I also think continuing to promote and continuing to be proud of sort of this American free market shareholder capitalism model, I just think it's going to definitively drive better economic outcomes and better social outcomes over the next 40 years as well. And that's why we created Strive.
And what is your vision for Strives in the future? How do you plan to scale the company's impact in the financial industry?
Yeah, so there's a couple different ways. So the long-term dream and vision of Strive is to be the world's most trusted asset management company. I think you become the world's most trusted asset management company by doing exactly what you say you were going to do, which is Strive looks to invest people's money to maximize shareholder return, period. Strive started in the ETF space because that was a way for people, if you had $25 in your pocket or you were a pension fund with $25 billion, you could invest in Strive's exchange traded funds, which trade on the New York Stock Exchange and trade on the NASDAQ and trade anywhere else. So anybody could access those. The longer term vision, though, is to build a whole suite of products for different individuals and different customers. Last year, we raised our Series B round led by Cantor Fitzgerald, and we actually started a Strive Wealth Advisory Group. And the Strive Wealth Advisory Group, this was a group that we had so many people coming to our website saying, hey, I have $100,000. Can I please, buy your funds? And we would have to tell people, well, you have to go call a broker at Merrill Lynch or at Edward Jones. And then we didn't know where those customers went. We decided to start a wealth management group that is now managing money on behalf of people. So not only investing into Strive ETFs, but setting up additional 529 savings plans for college, helping people think about other assets they might want to invest into, like private equity funds or venture funds. So now we have a whole group doing that. I think down the line, I wouldn't be surprised if Strive gets into some of the private kind of funds as well. For example, I actually spun out a private equity fund from Strive called Athletic Capital, which invests into consumer businesses. And for the time being, we spun that out just for kind of regulatory reasons. But I think there's a path in the future where potentially Strive launches private funds as well. And I think that will allow us, I think if we keep doing what we say we're going to do, that will continue to build more trust. And we could potentially be one of the largest asset managers in the world as well.
Got it. Very interesting. We would like to close off this podcast by asking your advice for students or professionals. As you might know, majority of our audience are undergraduate students and young professionals. So for people who are interested in breaking into the fields of asset management or just finance in general, any advice you would give to them?
Yeah, I mean, the first thing I always give, the first advice I always give to kind of younger folks is make sure you're passionate about doing it. I think a lot of people want to go into finance because you read about it. It seems like there's a lot of successful people in it. You can make money in it. But I always think that people are generally going to be happiest when they do three things. They're kind of the overlapping Venn diagram, and you want to be in the center of it, which is one, go into a career, go into something that one, you're excited about, you're passionate about. Two, go into something that you're good at. And when I say good, you're good relative to a lot of other people where you have had success either in your classes or in internships. And the third piece is find something that is going to pay you money to be able to pay your rent and do the things that you want to do. So if you want to go into asset management, again, just make sure you're passionate about it. You're going into it for the right reasons. Go into it because you're good at it. And then again, go into it because you can make some money doing it as well. And then so if you check those three boxes and you're going into finance, I try and go and find a great firm that has a good training program. Going into investment banks, going into groups that have a real training program. They're going to show you how to do the actual modeling of companies, that are going to help you see a lot of transactions that are happening. Those sort of early learning experiences are going to create good muscle memory, where you're going to start doing pattern recognitions of good businesses and good cash flow dynamics and how you think about valuation. And there's a lot of people that you're going to learn a ton of things from early on in your career. And I think that's going to give you then the ability to either go into other firms or start raising money on your own. Because whenever people want to get out and create their own firm, the first question you're going to be asked, well, what's your track record and what's your experience? And how do you know that your strategy is going to work? And being able to clearly speak to, well, these are the deals I worked on. This is how we source the deals. Here's a whole other pipeline of deals that I can go and do. That's going to allow you to just be more successful when you go out and raise capital on your own and create the next great asset management company in the US.
Got it. Thank you so much for your time. It's great learning about your journey and Strive, and thanks for your advice.
No, thank you so much for having me today. I really appreciate it.
Again, thank you so much for everyone for listening. We really appreciate having Mr. Anson Frericks on the podcast, and we hope all of you enjoyed this session as well. And yeah.